the reserve currency number one in the global financial markets. Euro is number two, and now Chinese renminbi is taking its ever more important place. It should be kind of freely floatable before it really can take over, say, euro or even US dollar, which I find very difficult to see. Okay, two first questions. The role of Reagan administration. I will come to the questions kind of you later, but let's have this. So first, the Reagan administration. That has to do with the regulation and deregulation. And this is, as I said, we'll discuss in more details when regulation is our topic. The market was, since the global crash in the early 1930s, a new regulation was adopted in the financial sector to avoid something happening that happened then, and that was that people lost their deposits, their bank deposits, when a financial institution went bankrupt. And one of these regulations was called Glass-Steagall Act, which then, over tens of years, made it impossible to form a bank or, say, financial institution where there would be a deposit institution and risk-taking investment banking operations. So simply, as simple as that, in the US, the Glass-Steagall Act made it impossible for institutions to form such conglomerates. Then what happened was that the Citi group was formed, and that happened in '98 when Travelers and Citibank merged. And as was explained in this documentary somewhat in the beginning, so this happened before the regulatory kind of environment allowed that happen. So they had a kind of a special right to do with it. What happened was that in 1999, something called Gramm-Leach-Bliley Act was adopted, which allowed big financial conglomerates to be formed. That's part of this deregulatory development that started since Reagan became president of USA. Another stream of this deregulation had to do with derivatives. Derivatives was something that we have been discussing here a bit already on this course as well. Deregulating derivatives markets, off-balance sheet instruments, which I added here one picture. This is from this the movie Derivatives, where it's $50 trillion unregulated market. That was derivatives markets overall, and that was in the late 1990s. Then what happened as a one specific product, which was a CDS market, which was essentially a non-existent in the early 2000s, but it grew in nominal terms to above 55 billion market in 2007. So that was a market that had, would say, a major influence on this bubble to burst. And that had to do with kind of how some institutions such as Lehman Brothers, which was number one player in this market. So that this market grew massively, talking about financial innovation. This was a financial innovation in late 1990s. And think about this kind of how you would even think about a new product coming to the market, and in just something like 8 years' time, the nominal value of this market would be 55 billion. So it's amazing, but that's reality. Since then, the market has decreased, have been shrinking quite a lot. It has not kind of disappeared. It's not that the one product is bad or not. The question is that kind of it became a source of something called a systemic risk, which was not recognized early enough. So this market was let to grow without proper oversight, and that was part of this deregulative kind of environment. This picture, this was from what George Soros was referring to, having these different compartments in an oil kind of oil tanks that big ferries do have. It was the idea in the regulatory environment before this deregulation that if a company, if a financial institution loses money in making risky investments, and the risks would realize, so that would not harm, say, the depositors, for example. So this was since early 1981, so for quite a long time, the common theme in the US was deregulation. And then after the global financial crisis, kind of the fashion a bit changed. And that is something that we'll discuss separately. Question: why were credit rating agencies criticized? That was a pretty big part of this movie, wasn't it? So what happened was that in the good old days, kind of home buyers would borrow money from a bank and make mortgage payments, and that was how the market kind of continued. And the bank had the loan in its books. Now, the new developments, financial innovation, innovation overall is good. And in this specific case, the innovation was this securitization. So banks no longer kept these loans in the books, but sold them forward for investment banks, or thanks to the investment banks, and investment banks then sold these to investors. Investment banks made portfolios of these different borrowings, not only kind of mortgage loans, but student loans, car loans, credit card debt, and packaged those as a separate packages, and these were then rated. Credit rating agencies were needed to rate these, and what happened was that the credit rating agencies gave pretty, say, good ratings for these portfolios overall, which led to increased profits. These are direct pictures from this movie. The criticism that is, of course, always sweet at the hindsight, but it has been later on even publicly admitted by these credit rating agencies. This is not from the movie, but I just took it from 2017 kind of a newspaper. So Moody's and Standard & Poor's have admitted, after a few years have passed since this global financial crisis, that they gave, say, the wording is inflated. So that means too high ratings for these packages, and also for these big banks, such as Lehman Brothers, Fannie Mae, Freddie Mac, which were the case companies in this movie. So companies, the credit rating agencies have admitted that they were wrong, say, in their opinions, which was one word in this movie. So they faced a very hard lesson during these crisis years. But today, Moody's is up and running, Standard & Poor's up and running, influential kind of money-making companies again. So they did disappear. And another question is that how much should we blame them, or should investors blame themselves also, not only kind of the third-party credit rating agencies, but kind of obviously the risk appetite was pretty high in those years. Okay, then the question about bailout of AIG and the consequences of Goldman Sachs. This was a pretty big theme. AIG, the biggest insurance company in the market, the biggest player in the CDS market as an insurance company or seller of these products. The question was that as AIG, Lehman Brothers was let go bankrupt. Had Lehman after that, just a couple of days afterwards, when AIG faced huge problems, challenges, had AIG been let go bankrupt as a big player, the biggest player in the CDS market, and especially as one case company was Goldman Sachs, so many counterparties, many customers of AIG had faced major financial difficulties as well, had AIG went bankrupt and not been able to pay their share in their contracts. Goldman Sachs is especially interesting in this case, as Hank Paulson, who was the previous Goldman Sachs CEO, became the Secretary of the Treasury in the midst of this crisis, sold his Goldman Sachs shares. The price was 400 something kind of million. Now, as the government bailed out AIG, so Goldman Sachs, as other counterparties of AIG, got their money, say, as was mentioned, 1-to-1, so 100% of their receivables, with no credit losses, no losses at all. So the question is that did Hank Paulson, being the Secretary of the Treasury, save his previous kind of colleagues kind of by bailing out AIG? Okay, you can criticize, you can ask your questions. This does kind of, in these kind of events, they're always messy. So kind of, you can think of kind of what would be the optimal, but all the decisions that are being made, they are made kind of in the heat of the night. The market is open every day. You just kind of you have weekends kind of to plan to do kind of make such arrangements that the market can open on Monday again. So, but that was the common theme that has to do with kind of a more general theme, had to do with Icelandic banks, has to do with kind of USA overall, is these revolving doors, kind of a regulators move from the government to work for companies and come back from the companies to work for the regulator or the government again. So the question is that do these incentives, are they aligned all the time with, at the end of the day, with the taxpayer money? As because taxpayers' money was used, this troubled asset relief program, this TARP program was worth 700 billion that was used to save the financial sector in the US. Then another question, why Raku Rajan was interviewed. Raku's kind of point that I find it very interesting as such, as at that time he was chief economist of IMF. He later became the head of Indian Central Bank. He published a book. This has to do with kind of a, sorry, not book, but research. This has to do with what we were talking last Thursday. Why didn't we see this coming? And I suggested that it's not only about knowledge. There are other reasons why we find it difficult to admit that some risks might realize in the near future. Raghu, who is, personally, I find that anything that Robert Schiller writes or speaks, I find always worth kind of reading and listening. And there's another person is Raku Rajan. Whenever he reads or speaks anything, I always kind of find them, that I learn something from them, because they are pretty clever guys. Raku already 2005 had been invited to make the presentation or speech in a meeting in the US where all the central banks, all the leading politicians meet every year. And he prepared a paper titled, "Has the financial development made the world riskier?" And actually his answer was that yes, he was concerned. So he somehow was able to see that now things are not okay. But then the question is that what was the reaction? Reaction was not that, okay, we get you, Raghu, and we start kind of working. No, it was the opposite kind of way, especially Larry Summers, who was advisor to the president then, the former Harvard president, again, Harvard professor nowadays. So he attacked Raghu because in a way, Raghu was kind of shaking the boat, which is something, he didn't have good news. And you could say that don't shoot the messenger, but in this case, Raghu, he writes about his experience in a book called Fault Lines. He explains how shocked he was after this presentation, and especially after the reaction, because he thought in advance that he would have something very valuable kind of to tell, and the message would be kind of taken, but the opposite happened. So that is something that Raghu was a bit shocked afterwards, even though he's right. Academics, interesting enough, what it is that this is the Mishkin, the author of our course book, Ikinä Mishkin. This is the Mishkin. He left the government in 2008, was it in summer, and he was asked that why did he leave? He says, okay, I had to revise a textbook. The question was that, okay, it is an important book, but kind of hadn't been there something kind of more important. The question about academics was raised, and this is the first time I find it fascinating myself, because this was the first time that in a movie like this, the role of academics was kind of questioned. The question is that kind of how neutral are these economics professors when they kind of act as a board members, not to mention kind of how they write reports about, say, the stability or instability about the Icelandic banking system or the regulatory environment in the US. This became a shock, as a shock in 2010 for academic community, because never ever this has been questioned. And the question is that, okay, should academics be more transparent in their links, with their links to private companies, government, and reveal how much money they make from these commitments? That was the first time that this was raised. Okay, now we have questions. Let me see it on the chat. Was this the first one? Let me see. One question is, would you act any differently if you were in the situation of the executives? Kind of a to-the-point question. And that is exactly to-the-point question. Has to do with incentives, as Ryan was referring to in his book, in this article. Just as a signal, kind of as an example, so kind of these bankers were not jailed after this global financial crisis, but they pocketed, many of them, hundreds of millions of euro or US dollars, but they did nothing wrong. They just did everything kind of right, and banks maximized their profits. And as it was also mentioned in this, was it Soros was referring to the city group's kind of CEO referring to until the when the music is playing, kind of you got to dance, and that has to do with incentives. As the market was kind of, you could say at the hindsight, pretty crazy. But then if you wanted to play in the market, everybody needed to be a bit crazy or play with the terms that were the terms at that time. So at the hindsight, of course, everybody could say that I had done it differently, but I wouldn't take it as given that kind of any of us would behave differently, as it depends about the incentives. As incentives, and that is the whole question here. That's why the banks currently in 2022 are complaining about the regulatory burden and different kind of regulatory requirements. But simply what happened was that in 2000, and that is what we'll discuss on Thursday then, who paid the bill was the taxpayers. And taxpayers said that the rules until 2007 were unfair. So heads I win, tails you lose. So banks, by taking the risk and making big profits, they were able to pay big bonuses, and shareholders got big dividends and so on. But then when the risks realized, the taxpayer was needed to jump in and save the banks. So heads I win, tails the taxpayer loses. So the rules must be adjusted. And our rules have been adjusted since 2007-8 until today. Banks don't like it, but this is just simply taxpayers are saying that we no longer want to kind of see anything like this happening, what happened in 2008. So the rules have been changed. Would you say it was kind of a perfect storm? Politicians and officials with a lack of an easing of regulation, finance industry, rating. Yeah, fear of missing out was one of the obvious kind of part of this kind of what happened. Now the question is this current environment very different from what early 2000? That is another question. But this was a perfect storm that kind of, you could say that everybody could be blamed. Regulator, big banks, consultants, all these lobbyists, kind of that whose role was also highlighted in this movie. I think that the core level, I think what, yeah, and this is, now we come to, at the hindsight, it's easy to see what happened. In 2007-8, you could say that it's easy to say what should have been done differently. That's also one could say. But then the question is that it didn't happen overnight. It took quite a long time to develop, evolve. And if you just think of market situation today, this where we are currently didn't happen overnight either. So that is why I referred to 2008 banking crisis, Euro crisis, COVID crisis, to understand how the market environment is as it is today. And how we'll move on from this, nobody knows exactly. But what we know is that the current environment is something that we have, especially the role of central banks, something that has been never experienced in advance. So obviously, we will move forward all the time. Life will continue, but are there some bubbles currently being built, say in bond prices, bond yields being kind of even negative? Remains to be seen. It's unhealthy, as Mikko was referring to, the banks facing difficulties in the basic kind of banking business in terms of profitability. That is something that we'll talk kind of later on. Especially the Finnish banks are in pretty healthy position in that case. In such a situation, Southern European banks are facing major difficulties. German banks, even Germany overall is pretty kind of healthy economically as a country, but the banking system is very old-fashioned, and so they very much are being hit by this interest environment. It's history after, exactly. But okay, we can't fix what the market was in 2007. We can't. That happened. What happened? But of course, we should learn or kind of sit for a while and think, okay, is there something that I can learn from this kind of what happened in the past? It's indeed a human problem, but isn't this the reason that the regulation is needed and necessary? Exactly. That is, regulation is, it's kind of a bit controversial, that kind of we are talking about the free functioning markets, and that was about the deregulatory environment, but it went, you could say that it went too far. It went kind of you need regulation, and something that was not understood at all was how interconnected the global banking system is, such as in Lehman Brothers went bankrupt in the US, so the whole operations were also halted in the UK. So they couldn't pay their bills, nothing was being paid. So these interconnections were not understood before this crisis. Now they're understood much better. Believer market economy, yeah, that is, if the other end would be that we will think, okay, let's think of the world where all the banks were owned by the government. So the question is that it leads to very interesting kind of conclusions or findings, kind of that how would that market work. So this is not the optimal that we are having currently, but think of what is the alternative. I guess the currently best alternative that has been kind of developed is that the current system plus a bit more regulation. Now, a lot of kind of good questions, kind of comments. I might be there. Okay, there you are commenting to each other. That's very good. After the crisis, new financial regulations, it seems that in the US financial regulations, that actually there has been a new, in the US, there has been also a new regulation, but actually pretty massive regulation as such. But then Donald Trump was pretty anti-regulation, and while he being a president, so this the tide turned again. So the regulatory environment, which had been tightened a bit, quite a lot since financial crisis, was lightened again during Trump era, and now currently over the recent couple of years, it has been a bit like a status quo. No major development there. We'll talk about this on Saturday, kind of Thursday more. The good kind of news for the US banking banking sector is that it has been pretty profitable kind of over these years, unlike Europe. So they're profitable on average. What you could say that it's not healthy, and what is not healthy is how, as Mikko was referring, that the Finnish banking system is very kind of condensed. So it's like an oligopoly. It's Nordea, it's OP, and Aktia. He said that they are the third largest Finnish bank. Okay, number 3 or number 4 after Danske, but the two big players make 70% of the market. So you could say the competition could be tougher. In the US, one of the reasons originally that was kind of identified, and that was also kind of mentioned in the movie, in Judge of Mo, was that the banks, they were too large to fail. So it would better to have the number of banks should be greater, so more banks and not as massive as they were before 2007. What has happened? Actually, the number of banks, the big banks, has become smaller in the US. So big banks acquired other banks in the midst of the financial crisis. Now these big banks are even greater than they were, talking about the US banks, before the global financial crisis, 2007-8. So that has not been solved. So that is something that the regulator must kind of keep watch closely. In Europe, what has happened was that this is something that we'll talk on Thursday, and next week's Tuesday is that the regulatory environment, the European Central Bank has taken responsibility on this. So that is something that there has been a change in who controls, and there's a reason. That is something that I will explain on Thursday. Some recent news. Kim is moving from OP to Hartwall. Okay, good. some very timely kind of online news that we are seeing. What could be a reason behind movements away from public funds to private? Okay, this is something that these are people specific kind of but Kim has been in OP for quite a few times, kind of, and it's a public, it's a private company, it's a big company, but it's kind of no idea. And Peter Seliksson, Peter is he's Ahlström, part of the Ahlström family, so kind of this is not the news that he will kind of and he sold, the Seliksson was sold to the asset management company, was sold, was it 2 years ago? 2 years ago it was sold to, was it LähiTapiola? So that explains pretty much that. Okay, any questions, anything else? Kind of we are kind of okay. Now it's 10 to 3 already. I have downloaded the Thursday's lectures. We'll talk about kind of, and we'll come back to Aktia a few times, kind of after we heard Mikko's kind of in his own words, kind of how he feels the challenges and the strengths of Aktia currently. We'll continue on Thursday then at 1:15. See you then. Cheers.